So we're going to go ahead and kick off the webinar. First off, I just wanted to thank everyone that joined us this evening for taking time out of their day. We truly appreciate it. We're super excited about this opportunity. We're going to walk you through the ins and outs of Alpine Creek Apartments, which is a 264 unit multifamily investment opportunity located in Tyler, Texas, which is about 104 miles east of downtown Dallas, Texas. So this slide outlines our disclaimer and confidentiality agreement. We are not going to read this word for word. Please do tune in to the slide deck that we'll be sending out right after this webinar and read this word for word. A couple points to point out. First off, this is confidential information. These are forward-looking statements and predictions. And then the information contained herein is believed reliable. However, accuracy cannot be guaranteed. All right, so we're going to share a little bit about the Prosperous team, specifically the general partnership team. We have 3 general partners on this property, myself, Dan Breezy, and Mason Thielen. For those of you that don't know me, my name is Mike Roeder. I'm located in central Minnesota, born and raised here, currently reside here, and I have nearly 15 years of experience in the real estate investing world. Started out in single family rentals in central Minnesota, accumulated a handful of those. And then I shifted over to multifamily about 6 years ago with Dan Breezy. He had been purchasing some mid-size apartment complexes, and we came together and figured that it would make sense for us to team up and buy some bigger properties together, get 2 minds working on the properties that we were working on. So we did that. Now I have over 1,200 units as a general partner. Prior to my full-time investing career, I was a high net worth insurance producer, did that for around a decade, and now I'm doing this full-time real estate investing. And now I'll let Dan Breezy introduce himself.
I had a professional snowboarding career kind of launch, and I wanted to find a way to transition to something that would create passive income and similar freedom that I had as a snowboarder. So I started reading a bunch of books and getting educated, and I hired a company out of Arizona called Provision, and they directed that I start to learn and invest in multifamily. And I went through a class with them, which was very educational, and I started buying some smaller deals on my own. I bought a duplex and a 9-plex, and then I bought a 24-unit deal. And then Mike and I bought a deal together, 28-unit deal. We both really liked what we were doing, so we decided to get trained up by a guy out of Dallas, Fort Worth named Brad Sumrock. And we would have been with Brad for the last 5 years. It's been a great experience. Fast forward now, we're working on our 11th acquisition. We've got 1,346 doors of asset under management as general partners, and we're looking forward to bringing this one to you guys as well. And then the gentleman to my right, Mason Thielen, I want to introduce him to all of you. He's an astute business guy out of central Minnesota. I went to high school with him as well. He's done very well in his young years as a business executive. And he came to us. He's an investor. He's been investing in all of our deals along the way. And he said he had an equity source that wanted to take a look at some of our deals. So Mason came to us, and here we have the Prosperous. The Prosperous was born. Mason's been an active real estate investor for over a decade. Through his connections as a Fortune 500 C-level executive consultant, Mason is instrumental in overseeing system implementation, networking, and capital raise. A little bit about the Prosperous. Mike and I's role in the company is to source and asset manage deals. Nothing has changed there. As discussed above, Mason will be bringing in a new equity source, allowing us to do bigger, cleaner deals with less partners is really the driving force behind it. The only changes other than the name will be longer hold periods with an emphasis on a cash out refi or a supplemental loan, and that added equity source looking at our deals. You know, right now across the board, we have 94.7% occupancy rates for all of our properties. We have 16 active properties, 11 different states with the property, 4,132 units combined between the 3 of us. And our average annualized returns on our full cycle properties has been 25.4%. One thing that Mike and I focus heavily on with our multifamily business is our team. our belief is the best team wins. So we like to build long-lasting relationships with some of the highest quality team members we possibly can. On the top left here, Sunridge Management Group. We've been with them for a couple years. They manage a couple assets for us out of Dallas, Fort Worth. It's been great working with them. They've been able to implement our business strategy on a couple of our other deals. They are excited about the East Texas market in Tyler, Texas. They did our due diligence with us on this deal, and they will be right alongside us as we close the deal and complete our business plan. Brazel and Associates to the right, they have completed 11 cost segregation studies for Mike and I. They've been great as well. They've given us 11 studies, and on all studies have beat or matched their projections. They will be taking care of our cost segregation study for us. Provision, the company to the top right there, I've been with them since day one. I've been 10 years with Provision. It all started there, learning the ins and outs of multifamily, and now they take care of all of our K1s. They take care of all of our tax returns, and they're going to be overseeing our LLC creation along with Callison Associates while they create our SEC docs. Callison Associates is our SEC real estate attorney. They do all of our SEC work. We've done a few deals with them now. It's been a great relationship with them. They get along well with Provision. It's been a great mix for these two team members. Cantrell and Associates, tax advisor specialist. Mike and I lean heavily on our tax advisor when we're projecting what our property taxes are going to go to after the sale. This is a huge number that's critical to get right, and we like to lean on the professionals that do this in and day out. Bottom left is Newmark Lending. Newmark is the first time we've worked with Newmark, although our broker, who we've done a lot of deals with, said that he's done a lot of deals with Newmark, and it's been great. So we have a lot of confidence in Newmark, and we're looking forward to closing this deal with them. About Alpine Creek Apartments, I'm not going to read everything on the right over there. You can go ahead and read in the blue boxes. I'm going to just touch on the key highlights. Our proactivity and strong relationship with the selling broker allowed us to purchase the property before any other competing offers were submitted. So this deal was on the market, and Mike and I look at a lot of deals, and finally when we come across one we really like, we reached out to our team and our best relationships in the business for brokers and told them we wanted to make an early offer. They made it line up. They basically said, come in at this number. If you can get here, it's yours. We looked at our underwriting. We could make the numbers work. So that's how this deal came to be. We feel grateful in the sense that we got it before the call for offers came. They were claiming 15 to 20 offers based on our history in DFW. When the brokers have told us that, they've been accurate, they've been right. And so we've just learned to trust the brokers and pay what we can based on our underwriting and our business plan. Phenomenal location near retail, business, schools, and easy access to Loop 323. When I was down there for 3 days completing our due diligence, I was excited to see the location near retail, businesses, and schools. 14.8% rent growth projected in the market over the next 5 years. That's organic rent growth, ladies and gentlemen. It needs to be understood. You divide that by 5 and you're looking at 2.96% of organic rent growth in this market. That's not with upgrading units. That's just on its own. We're underwriting 2% for our future rent growth. It's located in a rapidly growing market of Tyler, Texas. We're going to delve into Tyler, Texas, and Mike's going to go into some great detail on that for you in a little bit. Less than 2 hours east of Dallas, Texas. We will be employing a property management company, Sunridge, that I just talked about a little bit before. We have history with them. It helps us minimize some risk and guarantee returns the best you can without ever being able to guarantee an investment. Our revenue growth and vacancy assumptions are substantially more conservative than what the data analytic firms are projecting. All that means is we're looking at CoStar and ALN, and they're projecting what vacancy should be, and we're using a higher number. We're looking at what revenue growth will be, and we're using a lower number. We have a substantial opportunity to place a supplemental loan on this asset, and this is definitely a focus of this business plan for a longer hold, is a supplemental exit to get some of your cash back sooner, cash out, tax-free, back to you as the investor. We're going to go into detail on that later as well. And then we found great upside increased rental revenue with the interior upgrades. I was pleased with our property tour and our submarket shopping the comps, and found that there's definitely room with our upgrades. We verified it with our physical shops. Significant opportunity to build back utilities, which is market supported. This is also backed by our management company, and we also verified it on our shop.
So I'm going to run you through a few photos of the property. So on the left-hand side, you see a snapshot or a photo of the new leasing office that the sellers recently renovated. On the right-hand side, you can see the signage as well as a photo of one of the buildings on the back side of the property. Now, one thing to note, the sellers have actually spent over $4.29 million over their 4.5-year ownership period. So they have stuck a ton of cash into this property. And you can really tell when you go and walk the property. A lot of the interior units have already been upgraded or have new flooring. A lot of the exterior has been taken care of. They have a brand new leasing office, a brand new playground, new dog park, and so on. So we're really excited about that. Here's a few photos of one of the interior units. And you can see that they've refaced the cabinetry. They've put in new resurfaced countertops, new flooring and paint, as well as light fixtures. And the sellers actually stuck about $2.1 million of that whole budget that they stuck into the property into the interior units. So a hefty rehab on the interior units as well. Here's a few photos of the amenities. As I had said before, the sellers recently put in a new dog park. They spent $41,000 on the playground that you're seeing over on the right-hand side. And then they stuck over $120,000 into landscaping. And on the lower right-hand corner, you can see the new leasing office. And I can tell you right now, it looks good in the photos, but when you actually step into that leasing office, it looks absolutely phenomenal. So something that really attracts solid tenants to the property when you have a really nice leasing office like that. And the sellers actually spent just over $238,000 on that newly renovated leasing office. You can see the pool on the left-hand side, nice looking pool. It's in very good condition. We're actually going to do some uplifting the pool area. So we're going to replace all of the pool furniture. We're also going to renovate the bathrooms that are right next to the pool. It's going to be a really nice looking space after we get done with it. All right, so a little bit on the market overview of both Tyler and Texas in general. So we're really excited about the market that Alpine Creek is located in. It's located in Tyler, Texas. And for those of you that don't know where Tyler is, it's about 104 miles east of Dallas, Texas. And Tyler is considered the economic hub of Northeast Texas. So a lot going in on that market, a lot of growth happening in that market in the past and projected in the future. The MSA population is 230,000 people, so a nice healthy population there. Job growth is expected to grow by 36.4% over the next 10 years, so about 3.64% each year. So very, very good job growth expected in the near future. And obviously with job growth comes population growth. The average median household income within 1 mile of the property, and this data comes from CoStar, is $49,779. So very healthy for this tenant base. And what that shows us is that the tenants are going to be able to afford the rent projections or projected rents that we're going to achieve. Moving over to the state of Texas, most of you likely know that Texas is one of the top states for business growth, population growth, multifamily investing. So we're excited that this property is located in Texas. It's also very landlord friendly, which we love. Looking at the right portion of the slide, you can see some of the stats that really stood out to us. So first off, #1 state for business creation. Also the #1 state for job creation. 57 Fortune 500 companies reside in the state of Texas or have their corporate headquarters there. 100 of the 1,000 largest public and private companies are also located in Texas. So just a phenomenal area to invest your funds into. All right, on this slide, we're going to be diving into the market metrics of Tyler, specifically the market resiliency analysis report that Berkadia ran for us. This is a really neat report that we have started using on our past couple of deals. We absolutely loved it. And we've outlined Tyler, Texas on the mid side of this slide. You'll see it outlined in dark black. And the first thing that we want to point out is how the resiliency score of Tyler compares to other markets in Texas. And just to give you some background, the resiliency score tells investors how resilient a specific market is in an economic downturn. So essentially, how quick can that market bounce back if there is an economic downturn like we've been experiencing over the last year? And the best resiliency score is 1.00. The lowest is 0.10. So you'll take a look at the resiliency score for Tyler, it's 0.74, which is actually the highest score we've ever seen. And we've ran a few of these reports. Now, we also talked to Tom Burns of Berkadia, he's a listing broker in DFW, and he did mention that this is the highest score that he's ever seen, running these reports as well. So we are super excited about that. The renter wallet share numbers, we're really excited about that as well. Tyler's renter wallet share sits at 26.3%, meaning that 26.3% of tenants' income goes towards their rent. Now, the lower percentage that number is, the better, because less of the tenants' dollars are going to rent. So they can afford, it's more affordable to live at the property. And when you're comparing that, you can compare it to the national average, which is 31%. Dallas-Fort Worth is 28.8%. So again, a very, very healthy number there. Also, percentage jobs in high-risk industries, very low percentage, sitting at 17.6%. So that actually outbeat every single one of the submarkets that we compared this property to in this area. And that really means how many jobs in the market are related to high-risk industries that could go away very quickly. Year-on-year occupancy change, 3.9%. So the occupancy over the last year is bumped up by about 3.9%, which is absolutely phenomenal. If you look at Dallas-Fort Worth, they've dropped by about 0.2%. So still not bad, but 3.9% is fantastic. Year-on-year effective rent change, 4.5%, which means the rents have gone up by about 4.5% over the last year. Again, comparing to the national average of negative 0.6% or Dallas-Fort Worth at negative 0.2%, that number is phenomenal. And this is all showing us how great of a market Tyler is overall. Occupancy rate, 94.8%. We verified this by shopping the comps. There were very few units that were vacant, a lot of properties with waiting lists. And we love getting into markets where there is a ton of built up demand. It really allows us to push the rents quicker and really drive our business plan quicker. And then unemployment rate, 6.4%, which is very healthy, considering what we went through over the last year with COVID-19.
Some economic drivers in proximity to Alpine Creek. I'm going to start on the top left there. Brookshire's employs more than 13,000 employees nationwide. It's a higher end supermarket. It's been around since 1928 in Tyler, Texas. Extremely strong employer. Broadway Square is a 625,000 square foot mall about to undergo renovations since its 1975 upgrade. That helps us feel like there's a path of progress going on there. Christus Trinity Mother Francis employs more than 4,000 doctors, nurses, and physicians. Super strong employer. The University of Texas at Tyler, it's 10 minutes from Alpine Creek and employs over 600 people. And then you've got UT Health East Texas, serves over 25,000 patients each year. A little bit about the Alpine Creek area highlights. Looking at the proximity, it's 5.1 miles from downtown Tyler, and it's 104 miles from Dallas, Texas, and 125 miles from DFW. We're close to a few schools, 0.8 miles from Hubbard Middle School, 1.7 miles from Tyler Legacy High School, and then 2.2 miles from Clarkson Elementary School, and finally 2.3 miles from the University of Texas at Tyler. Again, we're hitting that 14.8% projected 5-year rent growth. That's the organic growth without the value add piece. when we do our value add piece, we will be moving rents a little further than that. 2.96 over 5 years. We're using, again, 2%. Population, 1 mile radius population is 10,901. 5 mile radius is 103,000. 1 mile estimated population growth for 2020 to 2025 is 5%. This is just a nice graph to show you guys, a chart, map to show you exactly where we're located in regards to some of the schools and businesses located in Tyler, Texas. If you look up to the right there, you can see the distance of 1 mile, and you can see where we are in location to the schools, the mall, Broadway Square, the University of Tyler, Texas, and a few other places.
All right, so let's run through our business plan and capital improvements. So the total additional value that we're going to be creating through our business plan is approximately 7.5 million. And on the left side of the screen, you can see the different opportunities that we have to increase the income. So first off, we're going to fully upgrade 132 units. And that's going to drive our revenue up by about 158,000. And we're going to partially upgrade the other 132 units. Now, those partially upgraded units, they've already been partially upgraded. So really, we're bringing them up to a fully upgraded unit. And that, again, is going to drive our income up by about 158,000. We're going to install 28 washer dryer hookups. Now, this is a bonus. We don't have any additional revenue factored into our pro forma budget. So we may be able to get additional revenue from these hookups that we're going to be installing. We're going to build out one additional 3-bedroom unit, and that's going to drive our income up by about $15,000. We're going to rub back the utilities, and we've basically proven this out that it can be rubbed back to the tenants. And we did that through our market analysis. So we shopped all the comps physically and noticed that almost all of them were billing back the bulk of the utilities. We've also talked to Sunridge Management, and they are very comfortable with billing back at least $99,349 worth of the utilities to the tenants. We're going to install 50 carports, and we're going to be charging $35 per carport, which is also supported in the market. And that's going to drive our income up by about $21,000 per year. Now, over on the right-hand side, you can see what our capital improvements consist of. Interior capital improvements will include LVP flooring, black appliances, upgraded lighting package. We're going to reface the cabinetry, tile backsplash, luxury resurfaced countertops, framed bath mirrors, brushed nickel hardware, and nude bathtub inserts for select units that have had some wear and tear. Now, again, when we walked all the units, we were pleasantly surprised at how many units had new flooring, new appliances, and so on. So we actually believe that we'll be able to tame down our interior unit upgrade budget compared to what we have projected right now. Exterior capital improvements, we're going to improve the resident amenities by adding a workout center and a business center. So right now there is a massive maintenance shop, and we're basically going to take 2/3 of that maintenance shop, build out the workout center and a business center, and then also an additional 3-bedroom unit in that space. We're going to improve the physical appearance through landscaping. We're going to rehab a select few pieces of siding and windows. We're again going to add those 50 covered parking stalls. We're going to rehab the pool bathrooms, replace the pool furniture, add some dog park features to really spruce up the dog park. We're also going to possibly install solar screens throughout the property. We've budgeted for this. However, we may reallocate those funds because our property manager essentially said that is not needed on this property. We're going to conduct a parking lot seal and stripe, and then we're also going to do some power washing on the exterior to really brighten up the property. We're also going to take advantage of bonus depreciation as well as a cost segregation study. We'll get into that further, but that's going to apply to the 2021 K1 tax returns, which we're really excited about. So this slide outlines our rehab budget. So on the left side, you can see our interior renovation budget, $1,482,400. And that includes updating to some extent all 264 units, adding those 28 additional washer dryer hookups, and then building out that additional unit. So very hefty interior renovation budget that we have to work with. We also have $474,050 for exterior renovations. And that includes everything that I just went through. You can look through the list there. We have 75,000 for the workout center and business center. We have some funds allocated to landscaping, siding, windows, covered parking spots, you name it. We also have a variance of $75,000. So we do have some funds that we can move around if we need to, in addition to the interior unit upgrades that we'll likely be able to shift some funds from. So again, super excited about how big our rehab budget is. It's $1,956,450. So about $7,400 per unit. And keep in mind, the seller's already stuck about $4.1 million into this asset. So very good amount of rehab dollars to work with. One other thing that we're really excited about is that all renovation dollars will be unfinanced, which really gives us maximum flexibility to shift it around as needed, or to possibly not use all the funds if we don't need them. Here we have a couple of photos of past project renovations that we've completed. On the upper hand side of the screen, you're going to see two photos of an interior unit. That's an asset in Minnesota that we recently renovated. And then on the lower section, you'll see a property in western Wisconsin where we fully rehab the exterior of the property. So just to give you a little insight on a couple projects that we've done in the past.
Getting into the investment summary here, ladies and gentlemen, remember this is a projected 10-year investor return at 147%. It's a 10-year hold, 14.76% projected annualized return, 8.04% projected average annual cash on cash return. Purchase price is $25,344,000. Estimated equity raise, 10.5 million. This is actually going to be a little less than that, probably closer to 10 million. Our debt appears to be coming back higher than what we underwrote, which should help our returns nicely. 264 units as a reminder. It's going to be a $100,000 minimum investment, accredited investors only on a first come, first served basis. Just to show kind of some of these returns to help you understand it visually. First of all, the projections include your initial investment being returned. So if you put 100,000 in, we're going to get you back 247,670 for the life of the investment. And you can just look going up 300,000 to 743, 500,000 to 1.238 million. And then $1 million in, we're going to give you your million back plus $1,476,700. Again, this is estimated after 10 years. Full fee disclosures for Alpine Creek, acquisition fee of 1.5% of purchase price, asset management fee of 1.5%, an investor sponsor split of 75-25. And then we have a waterfall structure that aligns with the general partners to try to exceed what we're projecting here. So if you see the 0 to 12% IRR, you're going to see a 75-25 split like we're projecting. If we can do better and get that 12 to 16% IRR, then it'll go to a 70-30 split. And if we can get 16% plus IRR, it'll go to a 65-35 split. Disposition fee, refi fee is 1% of appraisal value. And then debt placement fee is not applicable. And then construction management fee, again, not applicable.
All right, so we do have a possible opportunity to put on a supplemental loan in between years 2 and 3 on this asset. And on this slide, we've outlined a $2.7 million supplemental loan. Again, this isn't factored into our actual projections that Dan just went through. But we do believe that it will be completely feasible based on our conversations with our lender and our business plan that we've outlined. Now, when talking to our lender, they actually believe that we should be able to get a supplemental above 3.3 million if we can hit our projections that we're going after. The supplemental loan at 2.7 million would kick back about 26% of investors' funds. If we are able to hit 3.3 million, that would be 31% of the limited partners investors' funds. And again, like Dan had mentioned earlier, this is tax-free wealth or tax-free income. It's not a sale. It's not a situation where you should be taxed on those funds that are coming off of the supplemental. And the really nice thing about the supplemental is it boosts cash on cash returns. So right now, like Dan had mentioned, we're at just above 8%. If we're able to achieve the $2.7 million supplemental, that actually boosts the cash on cash returns over the life of the investment to just over 11%, which is really great. So during our deep diligence, we identified a significant amount of additional annual revenue that may be achieved. And these numbers on this slide, again, are not built into our pro forma budget. So total additional annual revenue that we believe we can achieve through a few different avenues is $190,062, and that's outlined in those 4 items below. Now, if we can do this based on a 6% cap rate, that would increase the value by about $3,225,000. So some phenomenal upside that's not factored into our underwriting. So first off, property tax savings. Our property tax consultant, Cantrell, is estimating that the actual property taxes that we will see will be about $76,000 lower than what we're projecting. And if that's the case, which we wholeheartedly believe in our advisor, the property's value will actually increase by about $1.271 million compared to what we have projected. We're also likely going to be able to bill back the cable. So when we were walking all the comps, we noticed that none of the comps were providing cable for free. Now, this property does have a cable contract in place for the next 5 years. And if we're able to bill back the cable at $30 per month for the tenants, that would increase our income by about $95,000 per year and drive the value of the asset up by about $1.58 million. Now, you'll see in our 10-year cash flow model, we do have it factored into our budget that we are going to be canceling that cable contract as of year 5, so our expenses will go down. However, if we're able to achieve the additional revenue in excess of what the cable contract is charging us, then we may keep it in place. Reserve parking. Also, while looking at the comps, we noticed that almost every single competitive property was offering reserve parking, and there were a significant amount of reserve parking spots rented out to the tenants. So we believe that we should be able to rent out 40 reserve parking spaces at $20 per month. That'll drive our income up by about $9,600 per year and create about $160,000 worth of additional value. Now, the last next level revenue item is converting the model unit. Right now, we have the model unit factored in as bringing in $0 of rent per month over the 10-year hold. Well, when speaking to Sunridge, they advise that they believe that we should be able to convert that model unit over to a rentable unit after about 12 months of ownership. So if we can do that, we should be able to drive the income up by about $12,600 and drive the value of the property up by about $210,000. So again, just a phenomenal amount of upside that's not built into our pro forma budget. Now, this next slide shows you the approximate returns if we were to hit all of those next level revenue items on the previous slide. So your 10-year investor return for LPs would go up to about 179%. The projected annualized return would be 17.9%. And then the cash on cash without the supplemental would bump up to about 9.31%.
All right, looking at some of the Alpine Creek rent comps. On the left there, you can see Alpine Creek. The number I want to point out here, ladies and gentlemen, is the $1.19 of rent per square foot. That's after our upgrades. After we complete the value add work, that's what we're moving the rent to. And we're still below some of the competitors there at $1.25 and $1.24 of rent per square foot. During our market survey, this is really where when we're shopping these competitor properties, we get the full picture of what we can actually do with the asset. What's the story of this deal and what will this market allow? And based on what we're seeing when we were secretly shopping the competitors, it helps us put together our business plan so that we're able to achieve our pro forma rents and have the returns that we have listed here with confidence. Our financing, Mike touched on a little bit. We're going to have 10-year debt. The 10-year term fits with our hold period. It's going to be Northmark Capital, as discussed above. We have a rate punched at 3.65%. Approximate maturity date is May 2031. Interest only is projected at 3 to 5 years. We have now confirmed we're going to be using 4 years of interest only. Amortization 30 years. It is a prepayment yield maintenance, but with our business plan, we're not planning on exiting. We're planning on putting a supplemental loan and exiting in years 8 and 10, which will greatly reduce the yield maintenance penalty. Loan amount up to, we actually confirmed this, it'll be 19 million. So that's higher than what we are punching, which will help returns nicely. It is a non-recourse loan. And then all rehab is unfinanced, as Mike said, which really just gives us that freedom to make changes as we need to hit our pro forma rents. There's a lot going on this page here, and I'm just going to touch on a few things briefly. You can see the sale price there on the top left, kind of 25,344,000. You can see our financing that we punched to show you returns of 73% loan to cost. That is actually 75%. We do have 4 years of IO, 3.65% interest rate. You can see our unfinanced rehab down here at $1,956,000. And then you've got your 8-year, 9-year, and 10-year total return that you can see there. If you move over to the right, it just shares the floor plan and unit mix for the property, and it shows the current rent. And then over to the right, you'll see the pro forma rent per month, and you can see down how we have $1.19 per square foot, which is a 10% rent increase. So with this market and the projections and what we've seen in our shop, we feel very confident, and our management company does as well, in hitting these pro forma numbers at a 10% rental increase with our value add strategy. Some of the pro forma expenses that we wanted to point out to you, currently they have $353,000 of payroll expense. We had Sunridge Management build out our budget, and they came back with $276,000 at $1,000 and $1,042 a door. So we can reduce the expenses there nicely. As Mike stated, we're going to be rubbing back approximately 80% of the utilities. This is standard in the Tyler market. We have verified that in our comp survey. This one is huge with taxes. We currently have the taxes underwritten to go to 80% of purchase price by year 3 of ownership, but our tax consultant, Cantrell and Associates, believes we'll experience taxes at 66.7% of the purchase price. If this does happen, we're going to achieve a $76,302 annual tax savings by year 3, which is absolutely massive, and that's not built into the pro forma rent. So I think you can understand the possibility and opportunity we have there and how conservative we're being. And then you can see the bottom there, yearly expenses and expenses per unit. The combined 10-year cash flow chart here, again, a ton of numbers. I'm going to stay focused on the left side. We're going to look at the rental increases that we're doing. We have used conservative underwriting on our rent growth and vacancy rate. Historical numbers have been pulled from CoStar and analyzed. As stated, CoStar projects 2.96% annualized rent growth over the next 5 years. And if you look at our chart here to the right, the big green box at the top, you'll see how we're projecting a 2%, the very top line, 2% all the way across the board. Again, that's just the organic rent growth, and we're going to be adding value to get more out of the market. Vacancy rate, historical numbers have been pulled from CoStar as well. We were looking at them, and they're showing a 7% physical vacancy rate over the next 5 years. Historically, they've been at 7.06 on average. We've used 10% as the economic vacancy rate through the life of the hold. Our reversion cap rate, we've modeled our reversion cap rate to be set 1.9% above our going in T3 cap rate and 0.2% above our going in T12 cap rate. I feel this is a very conservative cap rate number. Cable contract, Mike talked about this a little bit as well. In year 5, you'll see in the big green box, year 5 projection, the negative 5.15% is a result of canceling the cable contract, reducing that expense. If we do achieve the full bill back of the cable to the tenants, we may negotiate better terms with the provider instead of canceling. We'll play that as it comes.
So what you're seeing on this slide is the cap rate sensitivity analysis that we've put together. And the section highlighted in gold is our current pro forma reversion cap rate, which again, like Dan had mentioned, is 6.1%. And that would project a 147.67% return over the 10-year hold period. Now, based on the trailing 6 going in cap rate, which is 5.2%, we're about 90 basis points above that. And 5.2% is very typical for this specific market, in our opinion. Now, it gets really interesting if you go to the left on this slide. If you're able to sell for, let's say, a 5.5 cap rate down the line, which we believe is likely achievable, our limited partners would see 178% return over the 10-year period. Now, if we were able to sell at a 5% cap rate, that would bump up to 209%. If we sold at our going in cap rate based off the trailing 6, which is 5.2%, it's not outlined on this slide, but limited partners would achieve about 196% return over that 10-year period. And then going to the right, if for some reason things really go haywire and cap rates actually go up further, more than the 90 basis points that we have built in, if we were to sell it at a 6.25% cap rate 10 years down the road, you'd still achieve 140.88% return over the 10-year period if our other projections are all hit right on the money. So our cost segregation and bonus depreciation estimates are outlined on this slide. Again, Cantrell and Associates, I apologize, Brazil and Associates are going to be taking care of this for us. Like Dan had mentioned, we've utilized them for 11 different assets. One of the assets, they hit right on the money. The other 10, they significantly exceeded their projections. So we're very, very confident in the numbers outlined in this slide. If you are to stick in $100,000 right now, Brazil and Associates, our cost segregation study company, is projecting that the year 1 depreciation losses applicable to the 2021 tax year on your K1s would project a $77,550 loss year 1. If you were to stick in, say, $500,000, that would bump up to $387,750 in depreciation losses for year 1 of ownership. So essentially, we are going to go in, conduct that cost segregation study, and take full advantage of the bonus depreciation year 1 of ownership.
A little bit about investor relations and distribution, so you guys are all clear on this. Mike and I are available all the time. Send us a text, an email. If you're not hearing back from us within 12 to 24 hours, I would send another email or another text, and we will get back to you. We're going to be sending out quarterly updates. They'll be sent out to limited partners. Updates will include an executive summary of the property over the last quarter, how the property is performing, and it will include financial reports so you can see everything. Our annual tax returns will be prepared as soon as possible after the closing of each calendar year. Provision will prepare the K1s for each of our investors and will be released as soon as possible each year. They will be securely housed on our investor portal site. And then we plan to do quarterly distributions. They're tentatively planned to start after 3 to 6 months of ownership. Distributions will all be made via ACH and will be tracked for you on your investor portal. A little bit of a timeline here and next steps. Purchase sale agreement was signed March 31st. Physical and lease due diligence was completed by April 11th to April 14th. Subscription period starts today, April 19th. Investor engagement begins today, April 19th. And our target close date is May 19th. Your immediate next steps are as follows: is just let us know if you are planning to invest in this deal. The history of our deals, they have subscribed quickly and oversubscribed quickly. So if you are interested and you do like it, let us know. If you aren't, that's okay. Just let us know as well. But upon receiving an invite email, you will need to set up an investor profile. Number two, you're going to follow the instructions to complete the investment documents based on your details. And then number three, an acceptance email will be sent when it's time to wire the adequate funds.
And then just a heads up, an accredited investor form will be sent out as well. And that's something that you'll have to have your CPA or attorney fill out. Very quick form, just noting that you are an accredited investor.
And to add, ladies and gentlemen, Granite Towers Equity Group is still alive and well. Mike and I are still the driving forces behind it. This is just an extension, I guess, a second business, but everything at Granite Towers remains alive and well, and we're as focused as ever on maintaining the assets and continually performing according to our business plans that we projected. So at this point, let's open it up for questions. If you have any questions you want to list for us, put them in the chat box. We're happy to answer them. Thank you again for being here tonight. I know how busy you guys all are, so we appreciate your time. Any questions? Go ahead if you have any questions.
So one quick question that I see, where can I find the deck or the webinar recording? We'll be sending out the webinar recording tomorrow, and the investment deck that'll be available later on this evening. We'll be sending out an email with the subscription link as well as the investment deck this evening. And that'll come from investors at the Prosperous email address. Any additional questions?
We have a question here. Why are you doing a fixed rate loan with yield maintenance prepay instead of a floating rate with a 1% prepay and much lower interest rate? The answer to that is we want to lock in the rate we have. We feel confident that with the rate we have, we can still meet our investor returns. The question is where do interest rates go? There's talk of them staying low, but every 6 to 9 months, it seems like there's new information from the Federal Reserve about how interest rates could rise and how inflation's right at our doorstep. So we've gone with the conservative path of locking in, and if we can hit our returns and add a supplemental loan, we feel safe that way.
It really fits well with our hold period as well. 7 to 10 years, the yield maintenance prepayment penalty will really be whittled down close to nothing or nothing by the time we look to sell this asset. And then we have another question. Can you discuss the rationale for an 8 to 10 year hold period? So basically, we would like to hold our properties longer term, 8 to 10 years, for a couple of different reasons. First off, we want the prepayment penalty to be minimized, all the while taking advantage of locking in a long-term interest rate where we're not going to have a floating rate that's going to adjust in a few years. We also want to be able to put on a supplemental loan or potentially refinance the loan to kick back that tax-free wealth to our investors. Another reason is we want to be able to achieve the asset appreciation a little bit longer term for this market. We see this market continuing to have fuel added to the fire and asset prices to go up significantly. So if we were to sell in years 3 to 5, I could see ourselves, wishing we hadn't done so. So we are really excited to hold this property a little bit longer term.
One of the questions here is, why is this investment a better situation for a 10-year hold versus a 3 to 5 year hold? That just depends. As we get into our business plan, if we see maximum growth and we're hitting a 39 million exit dollar in year 5, we may consider selling. It's possible, but at the end of the day, our goal is to accumulate real estate and accumulate passive income, not jumping in and out of properties left and right. It's to continually add units, increase our passive income, and do it with the same dollars over and over again. And a longer term hold fits that better.
Another question here, do you still do the supplemental loan if interest rates go up, and what would be your limit? So that's something that we're going to assess when the time comes. So when we're in between years 2 and 3 of ownership, we're going to take a look at the current rates, what type of supplemental loan we can get, what our debt service coverage ratio is currently at, and what the property supports, and make an educated decision on whether it's worthwhile or not.
There's just some great questions. If you have any others, ladies and gentlemen, feel free to drop them in the chat box here.
Another quick question. Did you cover sensitivity analysis? We did take a look at a cap rate sensitivity analysis. We did not take a look at the vacancy or rent growth sensitivity analysis on this webinar. However, feel free to email us and we can certainly send that over to you. We'll give it a couple more minutes here and see if any other questions trickle in. One other note that I just wanted to mention was we recently had a discussion with a pretty large investor in the DFW market. He has a few assets in Tyler, owns about 5,600 units. And, he did mention that those assets have been doing very well over the last few years. So, gives us additional confidence in this asset.
One of the questions here is, will you refurbish apartments as they turn? Yeah, definitely we will be. We'll be executing our business plan, value add upgrades that we went through as apartments come vacant.
Do you know why the current owner is selling? So this is a large owner. They own quite a few assets, and this is the only asset that they own in Tyler, Texas. So that's one of the main reasons why they're selling this property.
Question here is, since this is a 70s property, has the electrical been upgraded? It has not been upgraded from our understanding, but with our management team very familiar with 70s property, that expense has been built into our pro forma budget per their expertise. So that's.
And another note on that, there's no stab block panels, there's no aluminum wiring, it's all copper wiring. So really we have, no concerns about the electrical on the property. What is the largest maintenance issue at the property? Typically on 70s built properties, you're going to be looking at either the HVAC systems or plumbing throughout the property. And we believe that we have plenty budget for both of those items.
One of the questions here is, Prosperous, just the two of you, or are you part of a larger group now? Ty, thanks for your question. We covered this earlier on. There's one other gentleman His name is Mason Thielen. He's a good friend of ours. We've known for a long time. He's an investor in almost all of our deals. He is going to be bringing this deal to an equity source and helping with some operations on the side. Mike and I will be the main asset managers, overseeing the asset and sourcing deals for the Prosperous. Just Mike and I.
All right, so I think we're ready to wrap it up. If you have any additional questions that we didn't get to, feel free to send us an email and we can get back to you as soon as possible, or give Dan or myself a call. Again, we will be sending out a email from investors at the Prosperous shortly after this webinar. It'll include the subscription link as well as the investment deck, and then we'll be sending out the recording tomorrow. So thanks again for joining us tonight. We really appreciate it.
Thank you, everybody. Let's keep in touch. We'll talk soon.